The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box. These are your headlines. Alphabet shares dip as YouTube and revenue disappoints over at YouTube on the ad side, I should say. Whilst Tesla stock slides on its fourth earnings miss in a row. But the CEO, Elon Musk, remains defiant on self-driving.
The value of Tesla overwhelmingly is autonomy. These other things are in the noise relative to autonomy. So I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock. They should sell their Tesla stock.
LVMH misses top-line forecasts. Chinese consumers pulling back on spending, making the French group the latest victim of a broader slowdown in the luxury space.
Deutsche Bank posting a narrow top-line beat in the second quarter. That's after the second straight quarter of double-digit growth in commissions as well as in fee income. We'll be hearing from the CFO, James von Moltke, at 7:30 CET. Spanish lender Santander ups its full-year revenue outlook after reporting a 20% jump in quarterly net profit. We'll speak to CFO Jose Garcia Cantera. That's at 8:10 CET. And BNP Paribas topping expectations with the Eurozone's largest lender, boosted by strong results in its corporate and institutional banking unit. The CFO, Lars Machenil, tells CNBC the outlook is not reliant on the ECB.
If the interest rates don't go sky high or they go back to zero, everything in the middle is fine for us. Because if it is a bit higher, it is good for some business. If it's a bit lower, it is better for us. But intrinsically, our plan can basically work independent of where it is.
Right, you're going to get a very mixed bag on the corporate earnings, as we've already seen in the headlines. Good morning to you all, by the way. The fact of the matter is, the top end of that mixed bag is a bank that's already had a 58% rally this year, and that's UniCredit. Quite frankly, I pride myself on being able to find a fly in the ointment in most corporate figures, but I can't find anything bad about these so far. The second quarter net profit, 2.68 billion euros versus 2.36 expected, albeit in a company-provided consensus. The revenue figure, 6.33 billion euros, 6.03 was the expected figure. They've upped the full-year revenue guidance to 23 billion euros. Net interest, 3.57 versus 3.51 billion expected in the second quarter. Commissions, again, slightly beating expectations. The CET1 ratio, you're going to see a lot worse CET1 ratios than that over the next few hours on this show as well. CET1 ratio at the end of June, 16.2, so plenty of regulatory capital there as well. What else can I tell you? Improved guidance for 2024 whilst retaining flexibility to further secure long-term ambitions for the next 2 years. So says the group there. Just a very quick word. They are making an investment in Vodeno and Ion Bank for 370 million euros. I'm sure Andrea Orcel will be wanting to talk about that as well. But this is a bank that is very well appreciated in terms of what they're trying to do under Mr. Orcel. Look at that share price performance versus some of the rivals. Huge rally, certainly over the last 2 years. As I said to you before, 58% higher on the year before these numbers as well. Right at the top end of the ranges where they closed. They started the 12-month period at a low of 20.44 euros back in September. They're now, as I say, virtually double that as well. And just for reference point, they trade on around about 1 times price to book. Sylvia will be speaking to the CEO of UniCredit, Andrea Orcel, I beg your pardon, and you can catch that interview first on CNBC at the bottom of the hour. Now, a bank that's doing okay, but nowhere near as stellar, perhaps in numbers, as UniCredit.
No, certainly not. And you see it in that share price also going up, 27% or so year to date when compared to what you've just pointed out as well with those numbers for BNP then, Steve. But really just focusing in on the numbers then for Deutsche Bank in the second quarter, Q2 pre-tax profit then is better than the market had put forward then. 411 million euros is the number then for that pre-tax profit. Estimates were 394 million euros then for that number. That CET1 capital ratio, 13.5. The estimate there was for 13.3 on that front, but losses attributable to shareholders of 143 million. It is actually better than what the market had expected, because Deutsche Bank analysts had expected attributable to shareholders of around minus 280 million. So around half of that. Q2 revenue, 7.6 billion euros then. That is actually slightly better than what the street had anticipated. It was also 7.41 billion euros in the second quarter of last year. So we'll get into the weeds of all of these numbers, of course, a little bit later on, although the CEO is saying well on track towards meeting our 2025 goals and our distribution commitments to shareholders. Of course, Carolyn did speak to the CFO of Deutsche Bank, James von Moltke, in the wake of those second quarter earnings. We'll bring you that conversation. It's coming up at 7:30 CET.
I'll just give one more number on that one as well. How can a bank expect to move forward while it's still got a cost-income ratio, various measures of between 70 and 80%? I just find it bonkers to think that it's like having a soccer team where you pay out 80% of the wage or of your revenues to your players as well. It's just not. I don't know. That's my personal opinion. I mean, they're saying it's 69% ex post-bank litigation provision, but 69% is still a horrendously high cost-income ratio. Again, just my point of view on that one. It was another disappointing quarter for Tesla, which is sharply lower in extended trade after posting its biggest earnings miss since January 2021. That is its fourth in a row. Margins at the automaker shrank to their lowest level in more than 5 years, and net income fell to just under $1.5 billion, with more than half of that from the sale of carbon credits rather than products. Musk announced another delay in the unveiling of Tesla's robo-taxi. It was already behind schedule and has now been pushed back to October from August. Musk has taken to X this morning to ask whether followers believe he should divert funds from Tesla. Really? Divert funds from Tesla to his AI startup XAI? Hang on, I thought that was the whole point of him getting $56 billion, that he was going to do all this within the Tesla brand. Anyway, this as he used Tesla's earnings call to repeat his argument that the company's output goes beyond EVs.
And I've said this before in earnings calls. The value of Tesla overwhelmingly is autonomy. These other things are in the noise relative to autonomy. So I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock. They should sell their Tesla stock. If you believe Tesla will solve autonomy, you should buy Tesla stock. And all these other questions are in the noise.
Well, there you go. Steve Wesley's joining us, founder of the Wesley Group, former Tesla board member. Arjun also joins us. Steve, well, there it is. And that bite says it all to me. Forget about everything else. That's all noise. If you believe that this company can deliver on autonomy, then go for it. Buy the stock, because it could be a multi-trillion-dollar company if they nail that. The problem is two things. One, their margins are looking decidedly ordinary compared to what they used to look like as well. Pretty much by my reckoning, if you strip out the credits and you strip out the storage batteries, actually they're around about 14%, which is not that stellar. And the second point as well is they're not growing their revenues. This is a pretty average car company that's betting on something that's not average, isn't it?
Well, I think it could be a little more than that. But let's look at the numbers. Small uptick in auto sales. They beat projections by $1 billion. That's not bad. But the real story here, an enormous jump in energy sales. So they delivered 440,000 vehicles in Q2, relatively flat-ish growth, 25.5 billion. But the big news is they doubled their energy sales from 4.7 gigawatts in Q1 to 9.4 gigawatts in Q2. So energy could be as much as $16 to $20 billion of their $100 billion revenues this year. That's extraordinary growth. They continue to do that. They're not only going to be one of the biggest car companies in the world, they're going to be one of the biggest energy companies. But as you point out, the big tamale, as we say in the US, is not just the car business or energy, which is impressive. It's can he convince the market that Tesla is a technology company, and in fact, not just a technology company, but one of the world's leading AI companies. We'll see.
Yeah, and all of that is really exciting. Before I let the lads come in on this one as well. Okay, so AI, really exciting. Got that. Robotics and the Optimus and autonomy, really exciting. Got that. A lot of that's for the future. Energy, couldn't agree more. Looks amazing on those energy sales. But I just want to concentrate on the bit about selling cars, which is how we all found Tesla originally. It's not that impressive, is it? The car selling bit of the business, which most of us think of first of all when we think of Tesla.
So, look, you're exactly right. They're caught now between two growth waves. Tesla introduced the Model 3 and the Model Y, posted the most rapid growth of any car company in history, 71% in 2021, 51% in 2022. Then things began to slow down. Some would say they have the bear cupboard phenomenon in between this next wave. Now, you want to give them credit where credit's due. Cybertruck, which was slow to start, recalls and so on, is now the biggest selling electric truck in America, selling more vehicles than Rivian or the Ford F-150 Lightning. So that's going up. They've got the energy. They control the largest charging network in North America and Europe. That's not bad. Tesla announced today that they would be coming out with a lower cost vehicle. It's not clear that it's the $25,000 one that's been ballyhooed a lot, but it looks like they may be coming out with something closer to $30,000. But the big question is robotaxis. They've pushed off the big announcement from August 8th to October 10th. I believe they're going to put a prototype out there. I think they're getting ready to get approvals for the full self-driving. It may start in China, where the regulatory standards are a little less steep. But if they can pull off autonomous driving, and I think they and Waymo are the clear leaders, that's the sort of thing that could propel Tesla's share price back up there. And then they've got the humanoid robots. We can talk about that as well.
Steve, it's Arjun here. I just want to focus on this robotaxi story for a moment. How will Tesla make money off this proposition?
Well, look, what people don't recognize is there are now 1.3 billion people globally doing ride-hailing. When you take roughly half the cost out of that by removing the driver, you're going to make ride-hailing available to literally billions more people. The vehicles should be more accessible. There'll be more on the street. The big question is, will Tesla own them all, or will they be owned by other companies? But the simple fact is this: Waymo and Tesla are way ahead of everybody else in terms of autonomous self-driving. We are closer to that than people think. You can go to San Francisco, Los Angeles, Phoenix, or Austin tonight and get in an autonomous vehicle with no driver or a steering wheel. So this isn't science fiction anymore. It's not 10 years out. It's happening now. Waymo and Tesla are charging ahead. Others don't get it. I'm not going to tell you it's going to be ready to go this year, but I can tell you it will be ready to go broadly around the US and Europe within 2 to 3 years.
And Steve, why don't you think that the regulatory approval is going to be a hurdle at this point? Because I know in China, they have a number of autonomous vehicle companies and robo-taxi firms operating, but of course the environment there is very different in terms of having to work with the regulators, etc. In places like the US as well, Tesla's going to have to work with the regulators as well on this. There's no indication yet that because there's no product on market that they've been doing that as of yet. Elon Musk is confident that they'll get regulatory approval, and why are you?
So this is why me. This is not that hard an equation to figure out. Waymo's been testing thousands of vehicles for over a decade. That's great. You accumulate a lot of data. Mistakes are made. Small accidents happen, hopefully not big ones. Data is captured. And unlike with human drivers, it gets recycled in the cloud and the vehicles become smarter. What gives Tesla this huge edge is they have over 2 million vehicles on the road today, all over the planet. They have more data captured than anybody else. And the difference is Elon is ready to throw the switch at Tesla when he believes he has reached that 99.999% safety rate. So is it going to happen in the next 6 or 12 months? Probably not. But when they throw the switch for for this low-cost vehicle, it will be a lower price per mile rate than anybody has ever seen before. That is going to change the global auto industry. I think once again, Tesla and Mr. Musk are thinking a little ahead of the curve. We just don't know exactly when, but I'll tell you now, it's not 5 or 10 years away. It's more like 2, 3, or 4. And if he pulls this rabbit out of the hat, he will have done something historic.
Yeah, Steve, good morning to you. Arabile here. I mean, you're also Western chair on the Biden now Harris campaign, and I want to swiftly try to move to that just as a final thought here. And obviously on the back of Elon having backed Donald Trump as well for president again then. But at the same time, you're seeing polls suggest that Vice President Harris is closing the gap on Trump, if not leading in some areas. Is this just pent-up excitement, or, is this a genuine chance for the VP to challenge Trump?
So I think you have two things going on here. America now is genuinely split between Republicans and Democrats, equal numbers of both, people kind of locked in politically and on the political left-right spectrum. But I think people in our country are yearning out to see some young blood, some new faces. The excitement about Kamala Harris closing up the nomination so quickly, tying it up. She's raised over $300 million in the 48 hours she's been in the race. She's got endorsements from every elected official you can imagine. Throw in Beyonce and Taylor Swift. This is a trifecta if you've ever seen one. So I think Mr. Trump may have more trouble than he bargained with. The big question now in America is, who does she announce as a vice president? Does she play it safe and choose one of the successful Midwestern or Southern governors to balance the ticket? Or do they swing for the fence and maybe consider Michigan Governor Gretchen Whitmer to have the first all-women president, vice presidential ticket in American history? We'll see. This will be an interesting one, but she's come out of the blocks faster than anybody ever dreamed.
Yeah, great comments, Steve. And of course, Gretchen Whitmer has done what all candidates do. And so I'm very happy with my job as I've got at the moment as well. But thank you very much indeed. We'd love to chat to you for about another hour, but we haven't got time. So thank you for staying up for us and commenting on various issues. We always appreciate it, Steve. Steve Wesley, founder of the Wesley Group and a former Tesla board member. And Arjun, thank you. We'll see you a little bit later on. Meanwhile, Alphabet moves slightly lower after the bell on the back of second quarter results, which largely delivered what Wall Street expected. Sales came in at 14% higher on the year, beating expectations at more than $84.7 billion, with cloud revenue topping $10 billion. But YouTube ad revenue disappointed amid increased competition from the likes of TikTok. Well, we'll come back with that story with Arjun later this hour. Don't forget, you can find all the earnings news on CNBC's website, cnbc.com.
And coming up on the show, we have a packed day of earnings ahead. We'll be hearing from the CFOs of Deutsche Bank, BNP Paribas, as well as Santander, as well as UniCredit CEO Andrea Hotel and Informa CEO Stephen Carter. All that ahead on Squawk Box.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Now, LVMH reported a second quarter miss on the top as well as the bottom line, sales growing 1% on an organic basis to just under 21 billion euros. That's compared to expectations of a 3% rise. Now, the luxury group said sales in Asia, that's ex-Japan, fell 14% on the year amid a big pullback in spending in China. Charlotte joins us for this one. Charlotte, you'd be hard-pressed to actually find a metric in these numbers that actually is pointing upwards, slowing global luxury demand overall.
It is indeed, and you remember just over the past few days we heard from other luxury players warning about their sales, particularly because of the impact of the slowdown in China. It was Swatch, Hugo Boss, Burberry, Richemont as well, having results quite flat and saying that their sales in China were being heavily impacted. So all eyes were on LVMH, of course the largest player in the luxury industry and kind of the bellwether of the sector. And certainly their sales missing expectation, but just by a little bit. So sales were up. So there was still a bit of growth on an organic basis, with sales up 1% in the second quarter, but certainly that's worse than in the first quarter there. And again, all focus on China, where there, as you were saying in the introduction there, Asia sales excluding Japan down 14%. So here again, that's worse than in the first quarter where they were down 6%. So things are getting worse in that region. But there's an interesting shift happening, because looking at Japan though, there the sales were up 57% in the second quarter after being up 32% in Q1. So we see a lot of the Chinese buyers not buying in China, but shifting and buying in Japan, traveling there, enjoying using also the weak yen there in that region. So we see that the Chinese buyer is buying in that country there. But that's an impact for LVMH, because the premium of which they buy in Japan is lower than the premium that they have in China compared to European prices there. So that's an interesting one. Looking at other regions, we see in the US sales were up 2%, and in Europe sales were up 4%. So a little bit of resilience there. They said the aspirational buyer is still being slightly impacted, but there is still a little bit of growth. Looking at the different parts of the business, we see fashion and leather, which made the bulk of sales up 1%. Interesting is wines and spirit, that was down 5%. They said people are not buying champagne. People are not happy enough to buy champagne and celebrate. A lot of uncertainty out there, and so that's being impacting. Cognac being slightly more resilient in the US. Selective retailing, big boost from Sephora, from that part of the business. So here again, for the second half, LVMH saying that they expect slightly more favorable comparables for the second half there. They said no reason to be pessimistic, but also that would be bold to be optimistic. So interesting to see what will happen in the second half. And of course, we know that LVMH is one of the key sponsors of the Paris Olympics. They create the medals with their brand Chaumet. They're dressing the team of France, and we're just a stone throw away from the Seine River. All the preps are going on for the opening ceremony on Friday. But we know that that could give them a bit of an extra exposure there, but a lot of uncertainty for luxury out there. And that's been impacting the shares for LVMH. They're down 20% over the past 12 months. We see Jefferies cutting their price target for LVMH off the back of these results. But here again, different results for the different luxury players. We know that Hermes, for example, that caters to the higher end of luxury buyers, is a bit more resilient than LVMH. Here again, the aspirational buyer being slightly more squeezed there when it comes to luxury buying.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.